Razor. Sanjeev Prasad, Executive Director and Co-Head of Kotak Institutional Equities, has also joined in now. Sanjeev, good morning. Thanks for joining in.
Morning.
Let me start by asking you about these oil companies, because we did get that diesel price hike, and I imagine that that will be a talking point in your conference this morning. What would you be telling your attending investors to do on the oil sector now?
Look, we have been positive on the oil sector for some time, and thankfully, we have seen some progress as far as reforms are concerned in the sector, and I think it is very, very important from a market perspective, because one of the themes which people will be focusing on over the next few weeks leading up to the budget is fiscal consolidation, and clearly the oil sector math is going to play a very big role in that. So the other thing is, this whole issue of reforms and how much people wanted to, believe that reforms will eventually happen in the sector, because this has been pretty much a very tough sector to implement reforms in. As you know, the government had announced diesel price deregulation as far as bulk diesel is concerned on Jan 17th, and announced a plan to raise prices by small amounts every month. At least we have seen one more round of price increase, so that will give more confidence to investors that the government actually means business as far as diesel price deregulation is concerned, and hopefully over the next few months we will see some more evidence of that. So I think from both a fiscal consolidation perspective and the reforms momentum, this is a very, very positive development. Immediate impact may not be much, but I think the sentiment impact is a lot more compared to the immediate earnings impact.
Sanjeev, we're doing the conference at the end of what's been a rocky earnings season. I mean, the last part of it would have raised some concern on the part of your investors. What are you going to tell them about how earnings are picking up, and whether the upgrade cycle has begun as people were expecting at the start of the year?
No, unfortunately not. I don't think there is much of good news as far as the economic recovery or the earnings upgrade cycle is concerned. We just put out a note over the weekend highlighting some of the trends in the third quarter results, as also an analysis of the third quarter numbers. And unfortunately, the trends aren't very good. If you look at the volumes, whether it is consumer staples, consumer discretionary, cement, etc., volumes have been trending down, which is clearly a sign that we are not seeing any economic recovery anytime soon. Look at the investment cycle, and particularly if you look at the investment demand and order booking for industrial companies, that is down 16% on a YOY basis. Third quarter this year was the third quarter of the previous financial year, so clearly there is no evidence of investment demand picking up. And lastly, as far as the banking sector NPLs are concerned, the trends were again quite erratic. You had some banks starting to see some improvement in terms of slippages. I mean, that was the broad trend, but on an overall level, the gross NPL numbers still increase a little bit. Again, the problem there has been revenue growth is trending down for the banks, which we cover about 16% loan growth only. Bottom line growth was only 8%, so you can see the issues as far as loan loss provisions are concerned for the banking sector. So the underlying trends are not very good as far as volumes, margins, profitability, or banking sector NPLs are concerned. Coming to the results, again it was disappointing, I would say. If you look at the BSE 30 index, we were looking at 11% YOY growth for the third quarter. That came at 7.4%, so that was about 3% lower versus our expectations. And this is despite some companies actually doing very well. So you had, for example, the IT companies and Reliance pricing on the upside. At the EBITDA level, things were actually okay. They were more or less in line with expectations, but you require a lot more as of now for this market to rally. And if you have weak underlying trends as far as the economy is concerned, I would say reasonably weak macroeconomic parameters, whether it's the score, the current account, and not much of earnings momentum, I would think this market will have to get some news from somewhere in terms of the reforms, a good budget, whatever it may be, for the market to start performing. Otherwise, we're looking at a pretty sedate performance based on whatever we have seen so far.
Hi Sanjeev, good morning. I'm actually looking at that note of yours that says where is the recovery, and of course, aside from the point that you've made about there being no scope for earnings upgrades yet, you've also raised concerns about the quality of earnings. Are you getting worried about what's happening on the core earnings performance itself, and whether or not there could be more damage to the course of this year?
If you look at the quality of earnings, there are two, three things which bother me. One is clearly the fact that other income is becoming a very large component of the earnings of some of the large cap names, particularly if you look at consumer sector. It's a very large proportion of the overall earnings, and in some cases it's as high as 30%. For the Nifty as a whole, that number has gone up to 25%, and particularly in case of consumer staples, at best I'm going to give the earnings which are based on, say, financial income not more than 15 multiple, which means that the core earnings of these companies are trading at even much higher multiples than what the optical numbers would imply. Just to give an example, for example, HUL is trading at, let's say, about 28 times March 2014 earnings, but 30% of the PBT is now coming from financial other income and operating other income, which should definitely get a lower multiple in my view, which means that the core consumer staple earnings are being valued at a much higher level compared to the overall composite earning numbers. So clearly that's becoming one area of concern. The second thing which I would worry about is the rising tax rates in some of the companies in, again, auto, consumers, etc. Because many of these companies now running out of tax shelters, and over the next 2-3 years you will see earning numbers starting to go up. So clearly this is two signs of not very good quality of earnings. And we didn't get a lot of balance sheet this time around because that only comes on a 6-monthly basis. But again, whatever numbers got disclosed by various companies, as also the banking sector numbers, it doesn't look like you are seeing any great improvement as far as working capital or bad loans, etc. is concerned. So there are some things to watch out for. On an overall level, the earnings may be still okay, but I think the quality of numbers is clearly deteriorating at a pretty rapid rate. And if you have seen this the last 3-4 quarters in particular, the working capital issues are becoming pretty big across sectors.
I know liquidity is the wild card, Sanjeev, but based on what you said and what you saw in earnings season, would you say the case has been made for valuations to actually contract a little bit rather than expand?
You have already seen that happening, Mitali, in a big way. I mean, forget about the market as a whole, which has probably been held up by a few names. You have IT companies which have actually gone up during the course of the year anywhere from 10 to 20%. You have the oil sector which has had a nice rally. Reliance has held up reasonably well. ITC has gone up again, 8-10%. And HDFC Bank again held up very well. So if you leave aside these 10 large cap names, the rest of the market is actually down a lot over the course of the year because the market is now flat on a year-to-date basis. If you look at it in rupee terms, it's absolutely flat. And if you look at some of the names in the metal space, etc., they have come down 10-15% over the last 1 month without anybody actually noticing it because the broad market are generally held. So again, it's becoming a bit of a worry that you are seeing such sharp corrections across stocks, and clearly it is showing that there is not much of confidence as far as earning numbers, etc. is concerned. So I think re-rating is looking extremely difficult in the context of not much of earnings momentum, underlying trends as we discussed earlier being reasonably weak. I would rule out upgrades in that case as far as multiples are concerned.